Well, the year of the landing, that's what Bank of America is calling 2024. Strategists at the firm say they expect disinflation to continue globally, allowing central banks to cut rates midway through the year. BofA also saying the S&P 500 will end the year at 5,000, an all-time high, not because of rate cuts, but because of corporations' resilience in this higher rate environment. Joining us now, Ohsung Kwon, who is Bank of America U.S. and Canada equity strategist, who helped put together that outlook for next year. Thanks for being here with us, Ohsung. Appreciate it. So when you look at next year, whatever the landing is going to be, is your 5,000 call sort of landing agnostic, if you will? You know, unless it's really outside the variations of sort of weak recession to, weak gains, I guess, in the economy.
Yeah, thanks for having me today. Great to be here. So we are forecasting 5,000 on the S&P 500 for next year. And our base case is basically soft landing in the U.S. economy. The reason why we're bearish is not because we think the Fed is going to cut aggressively, but rather because of what the Fed has done already in terms of controlling inflation down, not putting the economy into a recession. And during that period, companies have adapted to this higher interest rate environment. Earnings started inflecting. And in fact, we think that Q2 was the bottom in terms of this earnings cycle. And we think earnings are likely to accelerate into 2024. Positioning is still pretty bearish, and we think we are past the peak macro uncertainty in terms of the Fed, inflation, and rates. And I think that sets up pretty well for equities into 2024.
And Ohsung, I don't know if you heard, we were just talking about the Fed expectations there. The market clearly expecting here that the Fed's done hiking, cuts are in the pipeline next year. Is that your base case, Ohsung, as well?
Yeah, so our economists are forecasting a couple of rate cuts starting in mid next year. But what we highlighted was that as a bull, you don't want a Fed easing cycle for wrong reasons. Historically, a Fed easing cycle combined with credit tightening cycle has been the worst environment for equities. So if it's a recession-driven Fed easing cycle, then it's more bearish than bullish. And you almost want soft landing, no recession, credit market staying healthy, the economy staying healthy, and with disinflation. And we believe that earnings can continue to accelerate despite GDP potentially slowing down. And if that's the case, that actually has been the best environment for equities when GDP is slowing down and EPS is accelerating. That doesn't happen very often, but that's our base case actually. And if it does happen next year, that sets up very well for equities in 2024.
And all of that amidst what, at least in the first half of the year, is likely to still be a relatively high rate environment. So I want to dig a little bit more into one of the other theses in the outlook, which is that companies have adjusted to this higher rate environment. How have we seen them adjust? What are some examples, and are they going to continue to need to do that, or are the adjustments they've made thus far, have they incorporated the higher rates?
Yeah, so first of all, the reason why we haven't seen a recession, or one of the reasons why we haven't seen a recession in the U.S. economy, is because a lot of debt is currently fixed, whether it be corporate debt or consumer debt. When it comes to corporate debt, 75% of total S&P 500 debt is long-term fixed. So it's a lot more manageable than prior hiking cycles. There are two reasons I want to say that earnings were in a recession when GDP wasn't. One is because cost was a little bloated, especially after the huge earnings upcycle that we saw post-COVID. So a lot of tech companies and other companies had to cut costs to get out of that earnings recession. And we saw signs of that happening in Q3. Q3 EPS was up 4%, a lot better than down 6% that we saw in Q2. Earnings grew 4% when real sales growth was still down 2%. So that basically speaks to companies' cost management and cost efficiency. The other reason why earnings were in a downturn when the economy wasn't is because the big shift that we saw from goods to services. When it comes to earnings, S&P earnings are 50% goods for 50% services. When it comes to the economy, goods are only about 20%. So the big shift that we saw from goods to services, that had disproportionate impact on earnings than the economy. our view is that that's going to reverse. That's starting to reverse. That pent-up demand that we saw in services, that's starting to moderate. We're starting to see some signs that destocking cycle is over in goods. Inventories are a lot healthier. That's what a lot of retailers are reporting these days. So if that's the case, there's been a very strong correlation between the spread between goods consumption and services consumption versus how earnings do versus GDP. And if goods start to outpace services in 2024, that's the recipe for earnings outpacing GDP next year.
And Ohsung, another variable I just want to get your take on. We're heading into an election year here, Ohsung. How does that play into your outlook, if at all, for 2024?
Yeah, historically, election years have been positive years for equities. It's actually been the second strongest years in terms of the presidential election cycles. And the Fed is done hiking, and in an election year, I think the Fed is probably going to be more careful on what they do. And if that's the case, we think the economy can handle the current level of higher rates. If that's the case, soft landing is our base case, and equities can work in a soft landing scenario.
All right, Ohsung, thank you so much for joining us today. That was Ohsung Kwon, Bank of America, U.S. and Canada equity strategist.